Dividend stocks are a safe harbour in this turbulent market. 2022 was a wild one for the stock market, with Russia's invasion of Ukraine and a spiralling inflation crisis roiling the markets. As the economy now risks a recession in 2023 and geopolitical tensions remain elevated, specific sectors like housing appear to be in a lot of trouble. So, what should an investor do? Dividend stocks remain a stable choice. Defensive blue-chip holdings manage to cope well during a bear market and continue offering strong income even during recessions. There's no definition of a high-yield stock, but most investors would classify it as one with a dividend yield higher than a standard benchmark, such as the S&P 500 index or 10-year US Treasury note. In 2021, the dividend yield of the S&P 500 averaged less than 1.5%, while the 10-year note bounced between 1.25% and 1.75%. Thus, many investors considered any dividend above those levels as high yield. But you shouldn't buy a stock because of its dividend yield alone. You need to make sure that the dividend payments are sustainable. It should be a high-quality company with stable cash flow, a strong balance sheet, and visible growth potential. With that in mind, here are 10 dividend stocks well positioned for whatever the economy may do in 2023. They all yield at least 3%, offering superior income opportunities from day one. The number one dividend stock is the Grupo Aeroportuario del Pacifico, ticker symbol PAC. Pacific Airport Group is a Mexican airport operator. It holds concessions for 2 airports in Jamaica and 12 in Mexico. Concessions for the Mexican airports run through 2048 and comprise automatic inflation adjustments. Key concessions include the large city of Guadalajara, the industrial hub of Tijuana, and other tourist destinations like Puerto Vallarta and Cabos. Mexico maintains some of the lightest COVID-19 travel restrictions, leading to a tourist boom. Passenger traffic reached pre-pandemic levels by late 2021 and continues to glide. For November 2022, Pacifico reported traffic numbers 22% higher than in November 2019. The firm also cut expenses during the pandemic, making record-breaking profits today. Pacifico has a variable dividend policy, pays out the vast portion of its free cash flow generation as dividends in any given year, and its shares currently yield 4.7%. Dividend stock at number 2 is International Business Machines Corporation, ticker symbol IBM. For many years, IBM didn't look like one of the best dividend stocks to buy as newer software and cloud companies soared, while IBM appeared to be left behind. However, the tides turned in 2022. IBM shares posted a total return of 18.2% in 2022, even as the rest of the tech industry sold off sharply. What explains the shift in view? After years of plunging revenue, IBM returned to growth. The firm's bold Red Hat acquisition gave life to IBM's cloud business. Meanwhile, the market's newfound focus on immediate profits and cash flow casts IBM in a better light. While IBM is a slow-moving company, its legacy relationship with numerous Fortune 500 companies continue to toss off gushers of cash flow. Shares yield 4.4% and have some upside if IBM can keep nipping in the market shares of bigger cloud computing providers. Number 3. Shell plc, ticker symbol SHEL. One of Europe's largest integrated oil and gas companies is Shell. It has been a pioneer in shifting away from fossil fuel reliance, and the company has invested heavily in renewables. It's also expanding its network of Shell service stations, Shell electric vehicle charging facilities, and Shell convenience stores. Shell believes this focus on the consumer will allow it to navigate the profitable transition to being a carbon-neutral company by 2050. Meanwhile, oil, gas and chemicals continue to generate more than 75% of Shell's profits. That led to windfall results in 2022, with the surge in energy prices. This positions Shell nicely for the upcoming years. It can generate boosted earnings off its existing fossil fuel assets, while pushing its cash flow generated into EV charging and other solutions. Shell stock is offering a generous 3.5% dividend yield now. Number 4. Intel Corporation, ticker symbol INTC. 2022 was a dismal year for Intel. 2021's semiconductor shortage rapidly turned into a glut, and as it pertains to Intel, demand for laptops and tablets went from year-over-year declines to record highs in 2021. In 2021, Intel could sell chips as fast as they could produce them, but now inventory is piling up and pricing is heading south as the semiconductor gold rush is over. However, Intel still has strong economics, and it is much larger than its rivals and has massive research and development budgets. It'll be prepared for the next upturn in the semiconductor market. Intel shares now yield more than 5%. Number 5. Enbridge Incorporated, ticker symbol ENB. Enbridge is one of North America's prevalent midstream energy companies. Enbridge's network of pipelines snake around virtually the whole continent, and it currently moves around 30% of all the crude oil produced in North America, along with handling 20% of the natural gas consumed in the US. It also has investments in energy storage, renewable energy, and gas utilities. Enbridge finds itself in a strong position due to environmentalists and government regulations. It's difficult to build new pipelines, given all the obstacles to further development, making the existing pipes much more valuable. Enbridge has also been a smart operator, using leverage prudently and not exceeding its balance sheets. This allowed Enbridge to maintain steady dividend payments in recent years, with its stock currently yielding 6.6%. Number 6. Citigroup Incorporated, ticker symbol C. Citigroup is one of America's largest banks and has an extensive retail bank operation. It also does investment banking and has a significant international footprint. The bank performed poorly during the 2008 financial crisis and made several questionable decisions, but today's valuation is totally disconnected from reality. Shares are going for just 6 times earnings and less than half a book value, even as Citigroup's operational results have surged owing to higher interest rates. Citigroup is now earning its highest return on equity since 2006, and these factors are attracting attention from famed investors like Warren Buffett's Berkshire Hathaway Incorporated, which bought a large stake in Citigroup's stock in 2022. Given Buffett's ideal reputation with financial stocks, investors should give Citigroup's 4.5% dividend yield a close look. Number 7. Walgreens Boots Alliance Incorporated, ticker symbol WBA. One of America's leading retail pharmacy chains is Walgreens Boots Alliance. The company witnessed a slump in recent years, but saw a renewed period of excitement in 2020. Walgreens' location became crucial in providing medicines and consumer products during the COVID-19 pandemic. That catalyst passed, and Walgreens shares fell again in 2022. Profit margins on the convenience store side of the business could possibly falter in an increasingly digital world, but investors seem too negative here. Walgreens is offering a 4.7% dividend yield, and pharmacies are unlikely to be fully displaced by the internet due to heavy regulations on online pharmaceutical sales. Another factor is patients wanting face-to-face contact with their pharmacists. Number 8 is 3M Company, ticker symbol MMM. 3M is a broadly diversified industrial conglomerate known for consumer brands such as Scotch tape, Post-it notes, and Ace badges. Its product line is broad and versatile, running from dental equipment to safety helmets. The firm earned more than 118,000 global patents and still remains a leader in innovation. 3M stock struggled in recent years due to economic weakness, which drove 3M shares down to their lowest point since 2014. Still, the company continues to increase its dividend annually, and its yield is up to 4.7%. There's more than just the dividend to support 3M's share prices. as shares are trading for 12 times forward earnings. Number 9. Stanley Black & Decker Incorporated. Ticker symbol SWK. Stanley Black & Decker is a leader in making power tools, industrial fasteners and outdoor machinery. The company enjoyed prosperity in 2020 and 2021 as people renovated their homes during the pandemic. But demand leveled off now that the economy has reopened. The company's profits went from record highs to well below normal. in a matter of months, but over the longer term, profits should normalise. The company typically earned an average of about $6.50 per share before 2020. Put a modest price-earnings ratio of 17 on its normal earnings, which gets to a $110.50 stock price, with shares yielding 3.9%. Number 10. New York Community Bancorp Incorporated. Ticker symbol NYCB. New York Community Bancorp is a big regional bank primarily serving the New York City metro area. The bank has grown over the years by helping multifamily apartment lending, being a leading source of capital for the New York City's apartment owners. These loans have made modest yields, but have been low risk over the years. All praise to the stability of rents and the housing market in New York City. Even when many banks were going down, New York Community Bancorp remained profitable and kept its dividends steady in 2008. The firm lately got final approval for its merger with Flagstar Bancorp, which paves the way for the combined firm's earnings to rise dramatically in coming years. Shares are traded for less than 8 times forward earnings and now pay a 7.6% dividend yield. All 10 of these dividend stocks offer an above average yield, making them stand out in the current low yield environment. Each has a solid track record of steadily increasing their dividends and showing no signs of stopping. Therefore, they're great income stocks to buy and hold for the long haul.